Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Today's agenda, we'll just go through our market update. Update the earnings trades and then show us some charts he's going to go through with you guys. So let's get started. All right. So overall market, I mean, we're pretty much the same here. SPX still in 1, Russell still in 8. The NASDAQ still in 1. So pretty much same as last week. We did flip. So last week, we talked about crossing over, the green pie. So we did cross and didn't hold much up there. So we're back below 50. We're not technically overbought or oversold, kind of in the middle. So let's look at the market pulse here. So you can see, back here, we were talking about it's kind of like gravity where it'll get up to 50. So after that, we talked about looking for it to level off, and pretty much as soon as it crossed, it leveled off. And then it turned over yesterday. Pretty ugly day for the market overall. So we'll have to see if that continues, or if we, I'd say we got two things that could happen here. We could get kind of crossing back and forth, or I think we get the follow through on the bearish move. Typically these moves go all the way down or up once they cross. So you could see they're pretty multi-week kind of trends generally before the cross. So here we're talking about, okay, we're going to run up probably up to at least 50-50. So that's like a couple weeks. Now we get to cross. So we'll have to see if if this continues down, obviously starting lower than where we get like a big run up on the bullish here in the 80s, 60s, 70s type thing. So, only got up to 50. So, it's not going to be like a long run like this here. It'd just be kind of a shorter. And I think there's a good example back here. Yeah, kind of like this. Now, this one got up to like 60, but, this one's back in May of 2022. You had a similar one here, basically like cross barely and then turned over. So very like bearish action overall. We're not getting like a big run up like these. We're just getting the little pop over. So what to see if that really rolls over, or if we kind of get some chop here. That's the kind of two circumstances I see generally when we cross. We'll make a decent move there. So not too much choppiness, and you can go back and see it doesn't happen that much. So probably back here, kind of chopping back and forth. So that's one outcome. But generally it'll make a pretty concerted move here. So that's what I would generally bank on, and then just kind of guard against like a chop type thing. New lows, we got a little spike yesterday, 256, nothing like huge. You have to see if those continue. If we get some kind of build up. These have gone. It's been quite a while since we've seen big spikes here. It's the last one in October. We just get these little mini ones since October. So that's always a big sign when things start turning bad. We get these spike ups like this 780. So in order for that to happen, we have to have a lot of stocks in state 8. So we're pretty good amount, 40% right now are in state 8. So, and this one has been chopping back and forth, and looks like it made a little break yesterday. This is the 200-day moving average. So above and below. So we had a nice, pretty good break right there yesterday. So obviously that's a bearish condition when the symbols below their 200 are well above the symbols above the 200. So, all right, let's pull up the some state-specific ones. Okay, so this is ones and eights. We say we never, got the cross. Back during that like bear market, it was pretty much, the state ones would like get up around the cross and then kind of turn over. So this one didn't get really that close to crossing. So 36, about 10 points away, and it's turned back up. So what we'd like to look for, if we're getting bullish, it's the sevens that really start popping, and then the fives. So you can see the sevens, last Wednesday started turning over. So that's what we talked about. Not a lot of breadth in this market, and this is pretty much showing that right now. So, these sevens will go to 8, and the others would be the twos kind of spiking from the ones. So those have moved up a little bit, but really it's the sevens that have rolled over, and those sevens are going into state 8. So, okay, let's go into the specific analysis. So SPX state 1 obviously had a decent start to this, but pretty much stalled out. We were talking about 4,200 being a real difficult marker. The high right now is 4,170 in the state. Didn't even get up to that level, but we said that would be really strong resistance. So, start out good. Now, really, the key is, this entry price 41. Let's call it 4,100. So we had a big move yesterday below that. So now that's going to be, resistance. We wanted that, if the bullish camp would want that to be support. So right now we're below. So, the next stop down is, 4,000 about, and into the stop losses. So really just going to want to watch that 4,100 level. This still stands up here as the, the top end of our range, 4,200, and then the bottom is 38. So we're still up on the upper end of our trading range. 38's a ways off here. So this would be mid-range, the 4,000. Just kind of watch this 4,100, and then also on the chart, pull it up. We're getting right near that 50-day. So we talk about a lot when symbols are in a bullish mode. That 50-day is going to be, we'd like to see that provide support. So that's going to be something you watch right here on the low end. That price right now is 40.50 for the 50-day. So I didn't see where we were currently. I think we're up a low, 40.78. So we're in between those kind of two levels, the modeling, the entry. So we're still below that 4,100, and then we're above, that 50-day. So, we want to see that, if we want to get bullish, we want to see this provide good support, bounce off, that pretty much range, that price and that moving average. So that's where we are currently. I'll just do the range real quick. And so that's the top of the range, 4,200. And then, this is the bottom of our range, 38. So still range bound. Don't see much of that changing. So, still range bound. That's kind of what I see here. Okay, now Russell, this one's telling us there's not a lot of breadth in the market. This one's in 8, and then SPX in 1, so couldn't be further from each other. This one, I talked about if we could get up in the stop losses, I'd expect this to transition, but, it hasn't gotten above, this high of 1813, pretty much on that day right here. So that's been the ceiling for, the Russell. Our range is 19 to 17. So, getting near the low end of that. So we're at, 1738. So we're getting kind of near that low end. But, we've been in here pretty much the average time. But we obviously haven't done, big moves. So this is going to be the key level, that 1700 if we get down there. Last time hit that, it really bounced off. You got down to 1689, just took off. So that's going to be your key level for the Russell. Let me pull this out a little. It was a big move yesterday, though. So here's our 19, and then here's our 17. So big thing here, obviously, it's going to be that 17. It's provided good support here. Broke here briefly, but even down here didn't get quite there. But this is going to be a range. The 17 should be very strong support down there. If that breaks, obviously, that's going to be big problems for the market. I think. That's kind of the key one. I think we haven't got. So this is going way back. These are pretty much the lows here, 1641, right? So it's not far from that 1700. So, this, if this thing breaks 17, I would expect, probably make new lows, if we can break below that 1700, but it provided great support. So, we'll have to see if we get down there, but currently at 1744, marginally down for the day. Okay, just kind of real quick here. Fed meeting next week, obviously, 80%. They say it's if it's over 80, it's pretty much a lock. So right now it's a lock for a quarter rate hike. So that's what I would expect next week. Unless something drastically changes, which I don't expect. Still talking about end of year. So market is still pricing in rate cuts here. So that's pretty much right in between 75 and 50 rate cuts here. So that'd be like a 50 and a 75 from where we're going. So supposedly next week we'll be at 50. So we'd be at this level here. And then, the probabilities for December are, between 75 and 50 cuts. So that's what the market's pricing in. Fed's obviously saying something different. So no cuts this year. So that is the disparity. So, and we point that out before. Okay. Other things. So we got the big bump from the banking problems. But they continued, going back, not big drops. This one was pretty big here. That was like 70 billion, but these ones have, that's like 18, 15, 18, 20, something like that. So they're running it off. Obviously they had to step in here because of the bank problems. But they're continuing the runoff, very slowly. So I'd expect that to continue. Like they said, no rate hikes. No rate cuts, and they're going to continue running it off the balance sheet. So That's what I'm pricing in. That's what I expect. And the market obviously sees something different. So see who's wrong in the future. I would, for the cuts to come, I would expect something to happen. That's how I see it. So, all right, want to pull up a couple things. M2. So you can see money supply. This is M2. We're at year over year, we're a 4% drop. So that's pretty big. We talked about M2 being a key component. Here's the chart I pulled up before. So this is year over year growth. So we've had 2 months of negative year over year. So -2, got even worse, -4. So this doesn't, even back here, great financial crisis, stuff like, .com type stuff. We didn't even see a contraction in money supply. This has been pretty much straight up for a very, very long time since, Great Depression. You can see here -12. So, these are obviously long time ago, 1800s and stuff, but, this is definitely concerning. Overall, I think it's a good thing against, to fight inflation. But, I think that there's a lot of problems that come along with that. And, the liquidity, the banking, all that stuff. I think if they just attacked the money supply by itself, and didn't go too high on the rate hikes, but just enough to, kind of stop the craziness in the housing market. I think that would have been the best plan, but they continue to raise rates and contract the money supply. So it's kind of like a double whammy. So that's where we're at overall market. The rates overall. Just want to pull those up pretty quick. Obviously, short term, you got some good yields here, 4.7 on a 1 year. The 10 years, 3.5, 3.45 kind of range. So, what I want to pull up another chart. This is JP Morgan, right? This is what they're paying, right? So here's the rates, 1 month, 3.67, 3.7, 3 month, 5, and JP Morgan's paying you nothing. So, I mean, even like these, and I think this is pretty much industry wide, right? I mean, this is, okay, you got a lot of money, just sitting there, they're paying you 0.02%. So this is a big savings for them. I mean, I saw some like statistic, like they'd be paying like 90 billion if they were doing like normal rates, like what they did in the past. But, I'm not sure, obviously if you need it for like working capital, for like company type stuff, okay, you got to you want to like a big institution, but, leaving your money here, average Joe, it's just, you're wasting it, if it's sitting there like in some kind of savings. I mean, this is their savings rates, right? 50,000, they're not paying you anything. So they're saving a lot of money, good on them. But, the consumers obviously should be a lot more wise than having $1 million parked here for no reason. But just wanted to point that out. I think a lot of banks are like this, but interesting.
That's why they're saying that, I think, deposits are fleeing to treasuries, or even there's other banks paying CD rates that are better than treasuries.
Mm-hmm.
And so that reduces the capital available to these bigger banks.
Yeah, well, I think their deposits have actually grown. Not sure why, year over year, but there's a lot of better places just to have your money. I mean, you can buy, treasury directs, you can buy a government bond, direct, and, just have it there, like short term. I mean, even doing like 6 months or something like that, you'll make way more, obviously. And, a lot of the money markets, and then, yeah, your local, like, your local banks, obviously they try and get deposits. So as long as they're in good shape, there's a lot better options. And I mean, I'm not sure why they've never, haven't reverted back to normal. It's like they don't want, they don't want too much in deposits or something. I don't know. They haven't reverted to like paying people money to have their money parked there. So, and people just keep it there, and they're saving a ton of money by not having to pay them. And, whatever money's parked there, they're getting, they're probably, lending it out for, a lot of money. They're probably making a lot of money off of this. So that's
So
cheap.
Josh, do you know how much that changed after the, Silicon Valley, the regional bank, debacles there? I was just wondering if the big banks all cashed in because they're FDIC insured, and some of the regional banks, all the depositors left for the big banks. And so if you're a big bank guy right now, you can say, well, why should I give out interest when everybody's got to come here because they're like fleeing to safety? And
Yeah.
so may as well keep my net interest margin pretty high.
Yeah. Well, this has been like this for a long time. I mean, yeah.
Thanks. I haven't noticed for a long time, so that's kind of what I was looking for. Thanks.
Yeah. Yeah, it's been a long time. I mean, if like come tax time, like you used to like get like a statement for the interest you paid, you have to pay tax on it. But it's like, if you have like a regular checking account and you keep it like under 10 grand, you don't even get $1, right? So you don't even have to claim it. Like you don't even get like the tax form because you get paid so little. And it's been like that for a long time. I don't know exactly how long, but very long time. So a lot of these banks. So that's why you go to like the credit unions. A lot of those pay well, and some of the banks that are trying to grow deposits, they'll pay. Obviously, this one, yeah. I mean, this is like, okay, they're too big to fail type thing, and people perceive them as like a safe bank, but you're paying for it. Yeah, I mean, if you're getting 0.1 and inflation's like 7%, I mean, you're losing money, right? Or even if inflation's like 4 or 5%, I mean, you're losing money by just having it in there. So, anyways, thought it was interesting. Want to pull that up. I'll open up to questions, comments.
I agree. It looks bearish to me with the green pie dropping and all that kind of stuff we talked about.
Yeah. Yeah, and I mean, like these rates. I mean, obviously the 10-year, like the 10 years kind of behaved. That could be a lot higher, but it kind of goes back and like 3.5s, kind of where it's like pegged to. It's like goes back and forth right around that 3.5. But if that got a lot higher, I mean, that would really affect like real estate and things like that a lot more. So this has actually been, I mean, if you look at the year over year, last year this time, it was 2.7, so it's only like 0.7 higher than last year. Obviously, further back in time, it got a lot lower, which is why like that First Republic's in trouble, because they got like the 10 years at like 1.3 or something ridiculous. But it's not that big of for all the inflation we've been dealing with. The 10 years not that much higher from last year. So if that starts really exploding upward, that would be big problems overall, because we showed that like consumer personal interest payments. I mean, these are like skyrocketing, with higher rates. I mean, it just go like, I mean, it's already going like almost parabolic here. So, but it'd be a lot worse. So, okay. Anyone else? All right. So I'll do a quick.
Hey, so Josh,
Yeah.
I'll say one thing. I was just looking to see what the VIX was doing today, because like you said, yesterday was a pretty ugly day, but it's still below 19. And I was also kind of just looking at what the SPX was doing, just going into Fed meetings the last 2 or 3 times. It seemed like when the market was downtrending right at it reversed at a Fed meeting, and when it was uptrending right into the Fed meeting, it reversed at the Fed meeting, and now we're kind of like have reversed a little before the Fed meeting, so we're in between there.
Yeah.
Not quite halfway, but on the downside. So maybe this time will be a little different. Like the point you keep bringing up is the disparity between the rate cuts versus not rate cuts. I think that will determine. I think we'll be range bound until that people either wake up and decide, oh, it's they're not going to cut rates. What are we going to do? And I think we'll see maybe a gradual downtrend, not a spiky one. But so that's what it sort of feels like going into this particular FOMC meeting. And earnings is, I don't know. We'll wait to see what let's wait to see what Joe says on earnings coming up. So I'll hold that till then.
Yeah, I think it's obviously Microsoft had good earnings. I thought Google had good earnings. Like they didn't react as well, obviously, but
I think there's still some AI hangover for Microsoft that's going to persist for a little while until it either does or doesn't. It doesn't show up in their bottom line.
Yeah. Yeah, like Google's pretty flat, but they had good earnings. So I didn't see what the guidance was, but yeah. All right. As far as I'll pull up, our earnings trades real quick. So obviously these took a little bit of a hit here. These 5 already closed out, but had some drops. I don't know, this this one, I think it's a lithium mine or type, this Albemarle. Yeah, that one. So I like that thing, like they had something about like Chile nationalizing and this thing like tanked. Yeah, like I think it was here. That was the day. Basically, they're talking about like nationalizing this, all the lithium production. So that one took like a big hit. And
yeah, the government came out and said they're going to nationalize. And then the CEO of Albemarle came out and corrected that all of the existing contracts would stay in place.
All right.
But that 2 days, that's why it dropped so hard. I don't think it's. I've got it open, but because it hasn't hit the close date, but I think that one's probably going to be a loss.
Yeah, I don't know if that one. I mean, 2 of them are looking pretty bleak. This Avis, I'm not sure why that dropped so much, but we got a little time left. This one's earnings are tomorrow, so capital, but that's pretty much like break even ish. But the market got sucked down pretty good yesterday with everything. Yeah. So, and you can see they're all in bearish states here.
Yeah.
So, well, we got a little bit of time. So hopefully they turn around, but that has turned it a little negative, despite these ones, starting off good. So these ones are open. Hopefully they come back, and then we had one bearish pre-runner that obviously just closed out a winner. This gold miner, so that one closed out. got some bullish runners. The banks, I think it's like a couple of banks here. So those ones have got hit a little bit. Still got some time on them, but three of the, two banks, and then this is like an asset manager type, marginally down. You got one closed, the Delta hit its profit target. So they took, in general, they took a little bit of a hit there, so we'll see if things stabilize. Hopefully they do. That was it on earnings. Any questions?
I'm trading them. I haven't booked a loss yet, but it looks like Avis and Albemarle are going to be losses.
Yeah, it looks like it. So
They got till next week before those.
right. Yeah.
Avis might recover, but I have a hard time believing Albemarle will recover. It's dropped pretty hard.
Yeah, it had a good, that's a big drop, but you never know. Just
Yeah.
get time here. So yeah, I didn't see anything about, like what happened here. I'm not
I
sure.
didn't see anything either on Avis.
Yeah. So anyway. All right. That's it for me. Joe, you ready?
Sure, Josh.
All right, I'll let
Hey,
you.
everybody. Let's share a couple screens. Let's see, before we go to the charts, maybe, just as far as earnings big picture, just trying to do a little bit of homework. And this is, a couple days old, but I saw FactSet, looking at the 2023 earnings for the S&P each quarter. This quarter, they're talking about a decline in earnings of around 6.5%. Second quarter, a decline of about 4.5%. Third quarter, an increase of about 2%. And then the big kicker is, and I've seen this in other places, the fourth quarter, they're talking about almost a 9% increase in earnings. So, we're kind of just getting started. I think the last couple of days, there's been a lot of releases. Next week, we'll be able to talk about, how many have exceeded or underperformed. We'll have some pretty good stats on that, I'm sure, through this Friday. So with, typically, the beats are in the low 70s, and, we'll see where they come in. But, first quarter, they're talking about a 6.5% year-over-year earnings decline in the S&P 500. So we'll see what shakes out over the next couple of weeks. Chart-wise, I just always have my eyes on those. Yeah, Dave.
That question, did when you're looking through doing your FactSet research, did they say whether the fourth quarter gains were based upon the rate cuts that were projected or not? The rate cuts projected?
No, I saw no detail like that, and I saw it somewhere else also, where everything was kicked out, into the fourth quarter. I think the expectation was just an improving economy, yada yada yada. I've read nothing about those rate cuts in relation to picking up earnings.
The earnings calls that I listened to last quarter, that's what they were primarily, most of them were agreeing with that. They were saying, well, it's going to be a couple of quarters, but the fourth quarter and the tail end of the year looks good. That was kind of like the typical CEO conference call chatter from not this earnings period, but last earnings calls, is that I recall, and the ones that I listened to anyway.
Well, do us a favor, because I think you listen to more calls than Josh or I combined. If that tenor changes, let us know.
I will. Okay. But it'll be my opinion, because I don't listen to them all. I focus on,
right.
a few. Okay. Just saying.
I'll let you know though. So many hours in a day.
Yeah, that's true.
So, always have my eye on the bond states. We're still bullish in all of them. State 5. We'll see what the future brings for them. So, in terms of the ETFs, There were 3 days this week where all 11 that we track were in bullish states, which I found interesting. Last night, the real estate XLF, kicked back into state 8. So we're out of the 11 bullish, but 10 are currently bullish and 1 bearish. The 2 ETFs that rolled into state 1s, so we're up to 7 state 1s now, were energy and healthcare. Here's healthcare, and I try to pull these charts up going back to the COVID lows just for perspective. But I thought I'd concentrate a little bit on some of the components in healthcare, because the healthcare sector is by far, well, not by far, but it is the second most important, from a weighting perspective, sector in the S&P 500. And you got tech just over 25%. Healthcare comes in just north of 14%, and financials below that, around 13. So I thought it might be worth, taking a peek at a couple charts just to see what a state 1 in healthcare, may suggest for the market going forward. You can see this thing has been, basically sideways and, pretty darn strong over, just throughout, the, whatever you want to call it, the 15-month bear market, kind of a sideways move. We are pretty close to all-time highs here. Here's the short-term chart, but I mean, I think all-time highs were around 132. I think as we speak now, the highs were about 143. Back when we got that counter trend rally just last year, we remember we had that rally in March. It was the S&P was about 2 weeks, and the healthcare stocks were a big part of that. So we're banging up against that right now. It'll be interesting to see whether as state 1 suggests, we got a long way to go. I mean, we're only in this thing for 3 days. You don't get huge moves percentage-wise because it's a relatively low volatility index. But, if we got another 4, 5, 6 weeks, maybe that will, give a lift to the markets. So getting under the weeds a little bit, 4 of the stocks make up, let me see, what is it, about 30% of the index. You've got United Healthcare, J&J, Eli Lilly, and Merck. Let me see, not J&J. Let me pull up. Sorry about it. Let me see. Well, J&J. That. Hold on 1 second. Let me see if. Sorry. Well, I had United Healthcare, and that seems to have disappeared. So I pull that up at the end. But J&J comprises just under 9% of the index. Okay, and as you can see, it's fairly well off its highs, and not in a state 1, just in a state 7. So, it's kind of middle of the pack, not necessarily leadership. Eli Lilly, their earnings are actually due tomorrow. And, when I hit this thing up, I was just pretty much blown away. I mean, this thing's trading at all-time highs. And, you can see state 1 for, about 3 weeks, coming up on average move. Earnings are, I believe, after the close tonight, they are looking for about, I think, $1.73 from what I could find. It looked like about $1.73 was consensus. That's well below last year, which was $2.62. I'm not sure, why the decrease, but certainly the stocks performed like a champ here. And so I think Lilly's one to keep an eye on. And here's, earnings surprises for Lilly lately. Last quarter it surprised. Some of the moves have been in the red. So, we'll see what tonight brings for Eli Lilly. But, I was just pretty much flabbergasted to pull it up and see this thing, trading at all-time highs. So we'll see how State One performs for Lilly. The other one is Merck. Merck's about 7% of the index, and it too has pretty much been on a tear. As you can see, their earnings come out tonight as well. That range is the 142, 145 per share range. So it's interesting when you go under the hood and, don't get a chance to do it too often, but just really surprised to see, a couple of these stocks, trading at all-time highs. So, we'll see just, we got the target one in Merck. We'll see whether these levels, turn out to be resistance in the short term, and we'll see how both Lilly and Merck react to earnings tonight. Merck has had they basically have beaten from a surprise standpoint, and then, mixed reactions in the marketplace. So that was, the healthcare stocks, again, because they make up about 14% of the S&P, I thought it was worth taking a peek at, some of the bigger ones. All the others are below 5%. That's why I picked out those four. United Healthcare, that I may pull that up before we're done here. The other sector that went into State One was energy last week. And, energy is, at least the ETF, almost 50% is two stocks. I think I've mentioned this before. It's Exxon and it's Chevron. So, this thing is kind of just going sideways again. There's the chart back to 2020 from a state modeling perspective. It's just kind of been going sideways. Be interesting to see if, this State One has any legs. Again, about 40 days, and we're just getting started here. So, I think just a couple of them to keep an eye on because they're just early days, in State One. Then I just wanted to take a look at some of the bigger charts, just because, we're in the trading range. It's earnings season. But, we've got Microsoft, we've got Apple, we've got Amazon, we've got NVIDIA, Google, and Tesla. Different charts I just thought I'd pull up just because, they're so important in terms of the weighting in the S&P. So, Microsoft, as Josh said, having a big day today. We'll see. Let's see. Target one is 294. We're well above that. Actually, the short-term high in Microsoft, I think, was we've traded through that, and actually, it's obviously been a pretty volatile, couple of weeks in Microsoft. But we're banging up about 300 in Microsoft now. Recent high was, back in July, I believe, about 315 or late August here, with all-time highs in Microsoft, in the neighborhood of 350. So we're going to be banging up on 300. And I think just an important stock at this point, with a new trend to keep an eye on. I won't say it's long in the tooth in terms of State One, but it has been in State One for a few weeks. And after today's move, we'll be up, close to the average move. So another one to keep an eye on. I think an important one. Apple, of course, is, obviously one of the bellwethers. There's the long-term chart going back to COVID. Been in State One for a little bit here. Nowhere near its average move. We'll see whether we can get up into the 174, 175 target one range, in the short term. Amazon, you can see where Microsoft, Apple, done pretty well. Amazon, struggling versus its, highs back in November, December of 2021. So a long way to go there. Just in a State 5 at this point. NVIDIA, I pulled this up a few weeks ago and was just blown away at the rally in NVIDIA over the last, maybe 3-4 months. you know, hell of a rally coming out of the COVID lows, certainly. But then, you know, recently it just, it's been on a tear. Earnings, I guess last quarter, you know, were awful good. So I think just another one to keep an eye on as well. Two more, we got Google, which a long way to go to highs and just kind of laying around in state 5. And lastly, and I wanted to pull this up because of, you know, the target levels, Tesla, you know, got crushed, as we all know, had a heck of a rally coming out of the 1st of January and trying to hold its own now in state 8 and just, you know, for a couple weeks. But Josh and I were looking at this yesterday, just very briefly, just wondering whether state 3 would hold, target 3 would hold rather. And last I looked an hour or so ago, it had not. You know, it was trading down around 156, you know, through target 3. So a mixed bag. I think, you know, always important to keep an eye on these more heavily weighted stocks. You know, all these guys are 3, 4, well, Apple and Microsoft are, you know, 12, 13% of the NASDAQ 100. You then drop, they're the two biggies, you know, and then, you know, between Tesla and Amazon, you're somewhere between 3.5% and 6% of the NASDAQ 100. So, you know, there are definitely issues that move the indexes. And, you know, from my perspective, always interesting to see how they're doing, you know, in terms of their states, you know, versus the average moves in period of time. So that's all I had for today. Happy to take any questions if anybody has any. If not, Josh, we're back to you.
All right, thanks, Joe. Anyone got anything before we close up? Questions, comments?
Oh, hey, Josh, just one more thing. Just in terms of, you know, what's coming out. We do have PC numbers. So inflation on Friday, obviously, you know, Fed is next week, but it'll be interesting to see what the inflation numbers are on Friday. That could be a market mover.
Yeah. All right. Well, no one's got anything. We'll close it up. Thank you all.
Thanks,
Thank
everybody.
you.